My name is Jake, welcome to the channel, and today's video I want to talk about why dividend investors love Prologis. This is a real estate investment trust that I own in my portfolio. Over these last couple of weeks, my wife and I, we've been traveling with our baby boy. We were visiting my family up in Utah. It's been snowy. It was snowing the entire time, so that was fun. As we were driving to and from the airport, we saw a lot of warehouse buildings. And I was thinking to myself, man, I wish I had enough money that I could invest into commercial real estate. And then it came, I realized, well, actually, I do invest into commercial real estate, but not, in the way that you may think, where I go and I buy the building. I actually invest into real estate through REITs. And REITs are a great way for your average person to get exposure to real estate, without having millions and millions of dollars. Not every one of us out there was born into money, and so we don't have the ability to go out and buy physical real estate outright. So really quick, if you are a follower of the channel, you know that I have my cash flow portfolio here in M1 Finance. Now, this portfolio is primarily qualified dividends. I do have some cover call ETFs in JEPQ and JEPI. Now, these are, taxed a little bit unfavorably, especially because this isn't a taxable account, because my wife and I, we plan to retire very soon, and we want to tap into the dividends to then pay for our living expenses. So I want to paint that picture for you. So for all of these years, my wife and I, we've been working our 9-to-5 job. We've been saving at a very high rate, investing money into our portfolio, into real estate, and we're very, very close. We're able to quit our day jobs and fully live off of the passive income from our dividend portfolios. For the last 10 years, it's kind of felt like, kind of a dream, but now as we get closer and closer, it's becoming more and more of a reality. So in this portfolio, this is not where I hold my REITs. I have 3 different portfolios. I have my real estate portfolio, cash flow, and our portfolio for our baby boy that we invest every single week. But in this portfolio, the real estate portfolio, these are not taxed favorably. And once again, this isn't a taxable account because I want to access the dividend before the age of 59 and a half. So ideally, if I was planning to retire after the age of 59 and a half, all of this would either be in an HSA or a Roth IRA, so a tax advantage account. So it's very, very important that you understand. But in this portfolio, I have a small handful of REITs in this portfolio. I have the Vanguard Real Estate REIT ETF here, and I have a few individual REITs that I own in my portfolio. If you follow my channel, I always talk about time horizon. Prologis is a growth-centric REIT. Now, you could kind of compare Prologis with Apple or Google. Now, you might be thinking to yourself, how can a real estate investment trust be compared to Apple or Google? Well, I'm going to share that here in a moment with the growth rates, and you're going to be pleasantly surprised to see that how comparable they are in terms of their performance. Now, just like how you have an Apple or a Google, you also have like an IBM or an Oracle. Maybe a legacy, technology company that's not growing as quickly anymore because they have such a large market share of their industry, of their market already. You could compare that maybe with, like a Realty Income, or maybe a healthcare REIT like an Omega Healthcare or whatever, right? So it's important to understand that REITs, they act very similarly to other equities that you may be used to, like a Costco versus a Coca-Cola, right? And there's different, these companies are growing at different rates. So we're going to talk about 4 things. First, I'm going to talk about Prologis and give a quick overview of the company. Then I want to dive into the fundamentals, talk about their dividend growth rate, talk about their funds from operations per share, all of that fun stuff. Then I want to go into what are the bulls saying about this company and what are the bears saying about this company. And then lastly, we'll take a look at the historical performance against the S&P 500. So that's really the purpose of the video, is to help you educate you and help you understand a little bit more about this company. I'm not saying to go buy this stock. I don't really make stock recommendations. That's not what I do here on the channel. I don't sell a course. That's not what I'm here to do. I really just want to entertain and educate. That's really been my purpose of creating this channel, because there's enough people out there on the internet trying to sell you something, and it kind of looks a little like this.
Hey, what's up, ladies? Y'all I'm from Saskatchewan. That's up in Canada, eh? Oh, Caesars.
Oh my gosh. Oh man. All right, cool. So first off, let me explain really briefly what is an industrial REIT. So there's plenty of different REITs out there, right? You can buy a retail REIT, you can buy a cell tower REIT. An industrial REIT, it can come in a couple different shapes and sizes. Most notably, ones that you'll notice are, distribution centers out on the side of the freeway. A lot of these are to house e-commerce, items that you would buy online that are then going to get distributed and transported to you directly to your home or to a local grocery store. So when I do some comparisons, it's really going to be focused on industrial REITs. And also to give you some context, so if you were to go and just buy the Vanguard real estate ETF here, what you'll notice is in the top holdings, one of the largest holdings is Prologis. So even if you didn't want to go and outright buy Prologis, the individual company, if you own VNQ, you're already getting exposure to this REIT and actually a hefty amount, almost 8%. So first off, I'm going to jump into their investors relations presentation here, and I'm only going to show a few slides, but a few things that stand out that you'll definitely want to know if you're looking at a company like Prologis. One thing that sets them apart from all of their REITs, and I'm going to show in a second, the different industrial REITs, but the one thing that sets them apart from everybody else out there is they are very global, right? They're in different countries across the globe, primarily in the US and in Europe, but about 70% of their buildings, their physical infrastructure, their physical buildings are in the United States. And so what you'll notice is they have about 5,500 buildings, but they have more customers in one single building, right? So they have 6,600 customers, and they have about 5,500 buildings spread across the US, Europe, Asia, and in South America. Now, this is probably what makes me most excited when I think about being a shareholder in Prologis, is understanding how well diversified their business is. Like when you think about it, this one company is almost like an ETF itself by how diversified their portfolio is. So when you look across all of their businesses in terms of the different sectors and where their tenants or their customers operate, Prologis owns the building. And they rent it out to Walmart or to Amazon. And where they make their money is, yes, in the price appreciation of the real estate. That's a given. But in their ability to collect rent. They're there to collect rent. And the way that their leases are structured is they will have contractual agreements and it will depend on the lease, if it's an old lease or a new lease, depending on the company and the location. But in many cases, they will have inflation-adjusted rent escalations written in the clause of the lease. And so without any negotiations, each year, these tenants are going to be paying more in rent. And that is how they're able to increase their dividend year over year and really grow shareholder returns year over year. All right, next, let's take a look and see where their facilities, where their buildings are actually physically located. And what you'll notice is that the majority of their real estate is where the majority of the population lives. If you look at the United States, the majority of the people in the United States are on this side of the country, down here in Florida, down in Texas, over here on the West Coast. But one of the most important things that you as an investor have to keep an eye on is their rent collections. During the pandemic in 2020, they took a big hit, and then 2021, they saw an uptick. But here's the interesting thing. Here in 2022, they actually saw an uptick from 2021. And so they're trending in the right direction. Now, 98% is not amazing, right? When you compare that, for example, with realty income, they're at, I think, a 99%. So even just 1% can have a massive impact on a company's ability to either raise, hold, keep, or cut their dividend. So this is really, really important to keep an eye on. So moving on, when looking at their top 10 tenants, you can see that Amazon and Home Depot and FedEx are their top 3 customers or tenants that lease the buildings from Prologis. Now, we can't talk about Prologis without talking about their acquisition of Duke Realty. Duke Realty was one of their largest competitors or one of the largest industrial REITs besides Prologis. They just completed the acquisition of Duke Realty for $23 billion. But the thing here is they didn't acquire the company in cash or debt. They issued new stock. So they purchased Duke Realty with stock. Now, the only thing about that is it was dilutive to investors, but it is what it is. It's just important to understand. So what does Duke Realty bring to their portfolio? Well, they're getting about 480 new buildings. So that's about 9%. In an increase of 9% to the total buildings that they own. With that, they got 500 new customers, right? And so that was about 8% of their total customers. So 8% of their new customers, 9% in terms of actual physical buildings. And when looking at Duke Realty's customer base, you can see that Amazon, Home Depot, and UPS made up their largest customer base. One thing that I think is really cool is you can go onto their website and you can actually check and see the different facilities that they own in a certain area. So for example, I live down here in Austin. Just looking here in the surrounding area, there's 3 buildings that are owned by Prologis. Here, one up in the northern part of Austin, you can see, you can actually physically see the building either in person or on Google Maps. You can read here what the the specs of the facility are, the square footage. And if you go over to Google Maps, you can actually scroll in and you can actually see the building itself. And let's see if we can do this live here. You can see the actual building. And so I think this was really cool, especially if you want to you want to look at your investments, you can see what you actually own. If you're a shareholder of Prologis, you are a shareholder and you own this building. All right, now let's dive into the fundamentals of Prologis. So first off, we have to start with sharing that they just recently announced a 10% increase in their quarterly dividend. Now, this is here in 2023 with all this turmoil, with interest rates rising, they're still increasing their dividend in double digits. This is really, really exciting to see. So the next part here, I'm going to breeze through this really quick, and I want to highlight some of the main things that I look for, as a dividend investor when I'm looking at different companies and trying to just kind of analyze them and see, these are the things that I look for. So first off, you're going to look at the starting dividend yield. They have a decent starting dividend yield. It's beating the S&P 500. It's a little bit lower than SCHD, for example, and it's grown its dividend here over the last 5 years at a comparable rate. But the thing that I like to see, this is what's really exciting for me. So when you go into the dividend yield and you go under dividend, the yield on cost, this is what gets me excited about this company as a long-term investor. As you can see, if you would have bought this company 5 years ago, your initial purchase, you would have had a 5.5% yield on that initial purchase. So let's say you bought $1,000 5 years ago, you're getting a 5.5% yield on that initial $1,000. Now let's say the exact same thing over the last 10 years. If you would have done that 10 years ago, you're getting just under a 9% dividend yield on your initial investment. This is what we call the magic of compound interest. This is the dividend snowball. So you can see that, when you're investing into growing businesses like Prologis, you're not only getting that starting dividend yield of 2.85, but in 5 years and 10 years, that dividend is going to continue to grow. Okay. And then the next thing here, when it comes to the dividend, one thing that I do want to highlight is, when you look at the last 10 years, it looks great. But if you go back to the great financial crisis, they actually cut their dividend almost in half. Okay. And so it's very, very important. Even great businesses can get into trouble if they overdo it a little bit, or if things happen in the economy. It's important to understand that nothing is for sure. The key differentiator between Prologis and a lot of other REITs is they don't have a lot of debt. So when they go to refinance their debt, they're not going to be servicing that debt at a much higher interest rate. Okay, so that's the key thing. So that's important to note is they did cut their dividend in the past. Now, when looking at the fundamentals, I want to head over to allreits.com. This is a little bit different than Seeking Alpha. They do a little bit better job when it comes to specific REIT data that we would want to look for. Seeking Alpha is great, but I think AllREIts does a little bit of a better job. I know the developer, his name is Daniel, he's up in Canada, but he does a great job when it comes to really looking at and analyzing real estate investment trusts. So I'll leave a link in the description below. All right, next here I want to take a look at, and compare Prologis to the other industrial REITs in here. And this is why, once again, this is why I like all REITs, is because you can compare the different industries, and you can do that here under the insights section. You can compare healthcare REITs, nursing REITs, retail REITs, everything under the sun. Okay, and so when looking at the market cap and the overall score, let's take a look at a few things here. This is what I want to show you is, yes, Prologis is obviously the largest here by market cap. You can see that. When it comes by yield, they're not the highest. So a lot of new investors, they think, okay, well, high yield means better. No, that's not always the case, right? So the next thing here is price to earnings. Very, very important. You don't look at the price to earnings ratio with REITs. This is actually labeled incorrectly. So once again, this is not price to earnings. This is price to funds from operations core, okay? Core FFO. And you can see here that they have just under a 24 times price to core FFO. So this is really expensive, by the way. So this is like Google and Apple, right? That's what I was talking about earlier. This is not a low multiple. This is a high multiple, and you'll see in a minute why this company demands such a high ratio here. Dividend growth has been at 13.5%. Debt to assets, whereas Prologis, it's way down here, right? Okay. And another thing that I wanted to show you is the countries you can compare. How does Prologis compare to other industrial REITs that are publicly traded, and how diversified are they there? You can also look at by properties. How many properties do they have? It's not even close. So this is, when comparing it to other industrial REITs. Now let's take a look at Prologis itself. So as mentioned, the price to core FFO is just under 24 times. You can, there's a lot of different, information here. You can take a look at it. You can use the link in the description. When looking at the core FFO, the funds from operations, this is the piece that I would probably recommend you take a look at, is core FFO per share. Because what we talked about earlier, they just acquired Duke Realty, and so they diluted shareholders. What you want to look at is per share, are they growing core FFO? And you can see that they absolutely are. So you can see that over the last 5 years, they've grown their, this is the equivalent of the PE, right? The core FFO per share by 14.5%. Okay, and you can see their debt to assets has actually gone down. This is another thing that you really like to see, especially when the Fed are increasing interest rates. Here, this is the size, the square footage of the buildings that they own and operate. Here's the occupancy rate here. You can see that. We took a look at that earlier. So all of this is in all REITs here. Prologis is trading at a premium like Google. You can buy Google today at the same price to earnings ratio as the price to core FFO as Prologis. Okay. Now I know that's kind of a mouthful. Probably a lot of you are going to be like, what does that even mean? It just means the premium that you're paying for the company. Okay. And so you're paying a really high premium, but the thing that you want to understand is you want to look at the dividend growth. But this is the key thing here, is can they justify it? And this is what you want to take a look at, is their core FFO per share. And so just to make a point here, I want to compare them to Realty Income, very, very well-known REIT. Realty Income trades at a 16 price to AFFO. This is why Prologis demands such a premium, is you compare the growth rates of Realty Income with Prologis, it's night and day. They're growing significantly faster than Realty Income, and that's why they trade at such a high premium. Now let's take a look and see what the bulls and the bears are saying when it comes to Prologis. To do that, we're going to take a look at the Morningstar report. So let's take a look and see what the bulls say. They say that Prologis has the largest portfolio of well-located industrial facilities and is in the best position to capitalize on e-commerce demand. And Prologis' recent acquisition of Duke Realty has given it an unrivaled scale in the industry. So what are the bears saying? So the bears are saying that industrial facilities are largely commoditized. New construction is quick to negate any imbalances in supply and demand in the long run. A slowdown in consumer spending could expose the asset class, increasing vacancies as seen in the global financial crisis. That's the key thing. This is what kind of concerns me is, remember during the financial crisis, how they cut their dividend in half? Right now, we're in a very different situation than what we were in 2008, 2009. And then moving on here, we have a record amount of new supply in the industrial pipeline, which could significantly affect management's ability to pass along further price increases. So the key thing here is what Morningstar is saying, if I were to summarize it, is that there's no moat. There really isn't a moat other than, I guess, their economies of scale, their relationship with their tenants, and their know-how there. But a building is a building. You could argue that the location is maybe their moat because they're so well positioned where the demand is. That's really what the bears are saying, is that there's no moat, that supply and demand is really what's driving this, and what if demand slows? Okay, well, no one has a crystal ball, but it's important to understand and look at both sides when you're evaluating the stock. What are the bulls saying and what are the bears saying? And then make your own opinion and see if this is a company that may or may not fit into your portfolio. Now what we're going to do is we're going to compare Prologis against the S&P 500. When we look back since 1999 in January, if you were to go all the way back from then, right before the dot-com bubble, all the way through the ups and the downs of the market here, when looking at this, you can see that just looking at the price, so this is what you see on Yahoo Finance, Google Finance, this is what you would see in those charts. You would see that Prologis has doubled the return of the S&P 500. But the key thing here is the dividend. The dividend is not factored in that. So when you look at the total return with the dividend considered and reinvested or just calculated as well, you can see that Prologis has greatly outperformed the S&P 500. Looking over the last 10 years, it looks like they've doubled, right? They've doubled the S&P 500. Now let's do another comparison and let's add SHD to the mix here. So in order to do this, you will need Seeking Alpha Premium. I'll leave a link in the description below. You can get 58% off. It's $100 if you want to sign up to Seeking Alpha Premium. But here, when looking at SHD, you can see that the total return that Prologis has actually outperformed SHD on a total return basis as well. Okay, and just looking at the price really quick. So even on just the price itself, as well as the total return. Now let's do one more here, and let's take a look at VNQ. So VNQ is the Vanguard Real Estate REIT ETF. When we compare VNQ, yes, it's absolutely destroying it. On a total return basis, VNQ has performed the poorest, I guess you could say. And in terms of the price, you can see that it's even underperformed even more. Okay, so I'm a huge advocate of investing into ETFs. I think your average person would be better off investing into ETFs. I'd say the majority of you watching this video should probably invest into ETFs. However, if you do follow the core and the satellite approach to investing, this is definitely a company that you may want to consider as a satellite position to your overall portfolio. However, once again, I would never recommend adding more than 5% to your overall portfolio. So if you're looking to add an individual company, you have a long-term time horizon, or if you're looking to add a little bit more oomph and growth to your portfolio, Prologis may be a company out there that may be a good fit for you. Now, you want to also make sure that you understand where to place Prologis. If ideally, it would be best placed in a tax advantage account like a Roth IRA. However, if you plan to live off the dividend much sooner in life than the age of 59 and a half, maybe you want to consider it for a taxable account like my wife and I do. Now, once again, that's all individual and personal. There's really no right or wrong answer. It depends on your situation and your financial goals. So with that, I hope that this video was helpful. I hope that you learned a little bit more about this company, and I'll catch everybody in next week's video.
Please subscribe subscribe.
Subscribe.
Please subscribe. Huh?
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.